Good afternoon and welcome to Vincents' 2018-19 federal budget update. So obviously we had the budget last night, the federal budget, and Kim and myself have been pouring through the budget papers, and today we're going to give you a bit of a summary of what was actually included in that budget. Now, this was first and foremost an election budget without any question of a doubt. Yeah, and the overall sentiment of the budget is fairly positive. And we sort of say that for three reasons. There's support for consumer spending, policies to support job and income growth, as well as confidence boosting measures that will help kickstart the private sector business investment. So last night's budget looked after most areas of the economy, while capitalising on the recent bounce in revenues from growth in company taxes and employment, while reminding voters an election will be held in the next 12 months. So with all that in mind, we'll now get into a little bit of the detail with it. So essentially, as I said, this is an election sweetener. And the primary policy around, or the framework around this budget is essentially the individual budget tax reform. I'll use reform's probably a little bit strong, but the tax measures associated with individuals. Now, last year, obviously, we had the company tax measures that were introduced and are still yet to actually go into through Parliament. However, individuals are now the target this year, and funnily enough, it's an election within the next 12 months. The way they've actually done this is quite interesting. They've basically staged it over a 6 or 7 year period, and they're doing it via tax offsets initially, and then they're looking to get rid of a tax bracket into the future, which is all well and good. Who knows if this government will actually be around come 2024 to actually see these measures introduced through or enacted into Parliament. So really the first measures will start from 1 July this year. So they're fairly quick off the back. The opposition has indicated they will support this measure. So we can all be guaranteed that the first step, if you like, will get through Parliament. From there, though, it'll be interesting to see what happens moving forward. So as far as the rest of the budget goes, thinking about really where they've tried to target. So they've really picked on, they've tried to encourage taxpayers generally, older Australians, basically superannuants. There's money in the budget for mental health, small business, even our spy agencies get a little bit of dollars, and there's an increase in the health budget. Regionals don't really get a lot of benefit from this other than infrastructure, which we'll talk about. Those that don't really receive much in the way of this budget is essentially welfare recipients, people who use cash, large amounts of cash for transactions. The ABC didn't fare so well out of this. Certainly certain types of property developers, those that own vacant land. Kim will talk about famous people, how they're impacted, and foreign aid is usually one that gets a Guernsey, and no different this year. So with that, I'll hand over to Kim to talk about the individual, how the individuals fared in the budget.
Okay, thanks, Brett. So as Brett said, that one of the pillars of this year's budget was changes to the personal income tax. Last year we had changes introduced, or over the last couple of years, changes introduced and still in progress of being introduced in relation to corporate tax changes. This really concentrates on the personal income tax side of things. As Brett said, it is a 7-year plan, and it really builds on measures that have been announced in previous budgets where the personal income tax brackets were starting to move around a little bit. And the 7-year plan is really happening over a 3-stage process, I guess. Step 1 is to introduce a low and middle income tax offset from the 18-19 year, and that will go to the 21-22 year. So essentially, this is going to be what they refer to a low and middle income tax offset, LMITO. And it'll provide a benefit up to $200 for taxpayers that have a taxable income of $37,000 or less. And it will provide a maximum benefit of $530 for taxpayers that have got taxable incomes of between $48,000 and $90,000. Now, it is tiered in between those two ranges, so those two thresholds. So it gradually introduces a benefit to the lower and middle income earners without really impacting on the high income earners, which was where the politics comes into play. Interestingly, this low and middle income tax offset will only be received as a lump sum on assessment of the individual's tax return, so when they lodge their tax return at the end of the year. So it won't be seen as an extra $10 a week in the individual's pocket, but rather a lump sum amount that they'll receive when they lodge their return, which is an interesting approach, I think. So it doesn't really hit the back pocket of the individuals for quite a while yet. So I think 2021 it'll start to hit.
Yeah, it's actually from a cash flow point of view, Kim, it's quite clever how they've done that to essentially delay giving people the tax benefit. I don't know how that's going to play out as far as the election mantra goes, though, because it's going to be some time before people actually receive that benefit, even though they're promised it as part of an election sweetener.
Yeah, exactly. Yeah, it'll be out of people's minds by then, I think. The second step in relation to the 7-year plan is relief from bracket creep. I was listening to some of the commentators last night where they were saying that it's interesting that bracket creep really only becomes part of the discussion around tax when we know there's an election looming. This year's no different. So from the 1st of July 2018, 1st of July this year, the top threshold for the 32.5% bracket will be increased from $87,000 to $90,000. And then from 1st of July 2022, the top threshold for the 32.5% bracket will be further increased from $90,000 up to $120,000. Now, from the 1st of July 2022, there'll also be some changes in the low income tax offset to deal with some of the bracket creep that impacts on low income earners as well. The third step in all of this is removing one of the personal tax brackets altogether, and that's the 37% bracket, and that'll be removed from the 1st of July 2024. So essentially, at that point in time, the 32.5% bracket is going to be increased from $120,000 to $200,000. So we can see that the 32.5% bracket is the one that's going to take most of the change over the next few years. So it'll increase it has increased from 80 to 87,000 already. It'll then move from 87 to 90, and then from 90 to 120,000, and then from 120,000 to 200,000 over the next few years. One of the other changes in relation to personal tax matters is Medicare levy. Now, there will be changes to the low income thresholds, as there are in most budgets, so they'll be increased. And in addition, the Medicare levy will remain at 2%. So in last year's budget, the government announced that it was going to increase by another 0.5%, in essence to fund the NDIS. But the government has determined that it can fully fund the NDIS without having to increase the Medicare levy. And so the Medicare levy will stay at 2% where it currently is. Now, one of the other impacts on individuals, not necessarily from a taxpayer, from an individual taxpayer perspective, but in the context of deceased estates, there's an increasing use of testamentary trusts in deceased estates. And as a result of the increased use of testamentary trusts, which are really just trusts that form out of a will, the tax office has I guess it's garnered the tax office's attention in relation to how testamentary trusts are treated for tax purposes. And one of the great benefits of testamentary trusts is in the context of taxation of minors, so people under the age of 18. And where a distribution goes to a minor from a testamentary trust, then that distribution is subject to tax at adult rates, whereas if that same distribution came from a normal trust, normal discretionary trust, it'd be taxed at minor rates, which can be, essentially penalty rates. There's been an increasing use of testamentary trusts, not only for the assets that were bequeathed from the estate, but also individuals putting additional assets into those trusts and therefore getting the benefit of distributions to the minor beneficiaries at those concessional rates. So from the 1st of July 2019, the concessional rates for minors are going to be limited to income that's arising from assets that have been transferred from the deceased estate or from proceeds from the disposal or investment of those assets. So if other assets are injected into that trust, then they won't get the benefit of the concessional rates that apply to minors. So here's just a quick summary of what the marginal tax rates will look like, what they look like currently, and where they're going to end up in 24-25. So you can see that 37% bracket is going to disappear altogether. Now, as with all budgets, there are a number of integrity measures, whether they're strengthening the system or trying to stamp out particular actions and approaches that people are taking to the way they personally administer the tax system. This year's budget is no different. Brett mentioned initially about schemes where individuals might try to license their fame or image. It's been something that's increased in recent years, where high-profile individuals, and normally we hear of sports people and actors, that license their fame or their image to another entity, so like a trust or a company, and the income from the use of that fame or the image goes to the entity in the form of some license. So when that income is sitting there in the company or trust, it might be taxed in a different way than it would be if it was in the individual's name. So from the 1st of July 2019, all remuneration, including any payments and non-cash benefits that are provided for the commercial exploitation of a person's fame or image, will need to be included in the assessable income of the individual. So the licensing of the fame or image to another entity will essentially be ruled out as what they're trying to achieve. So so it's an interesting crackdown, I guess, on that sector of the community. Also, in relation to individuals, the ATO funding has been increased to provide additional compliance activity targeting individuals specifically. So there are other aspects of funding that have been increased for the tax office, but this is very specific to individuals. So from the 1st of July this year, there's an additional $131 million being provided to the ATO to essentially increase compliance activities that target individual taxpayers and also their tax agents. So for the accountants out there that are listening, this is aimed at us as well. So the measure is basically to enable the tax office to continue their income matching, data matching activities that they're carrying on. Some of those were due to finish by the 1st of July this year, so they'll be able to continue. And they effectively allow the ATO to determine whether income has been reported incorrectly or not at all. For example, where there's foreign source income that may not have been included in individuals' returns. This additional funding is also going to be used by the ATO to provide additional audits and prosecutions. Yippee, we say. Lots of audits going on. There's a lot going on at the moment, so it's only going to get better or worse depending on what perspective you're looking at it from. There'll also be a focus on improving education and guidance materials. That's so that we don't have to have an audit or don't fall foul of an audit. The pre-filling of income tax returns. We've all seen a marked increase in the level of information that's coming through in tax returns over the last few years, from the ATO being able to gain that information from other sources. So that is only going to increase. And there's also going to be an improvement or an increase, I guess, in real-time messaging to tax agents and taxpayers in relation to overclaiming of entitlements. So where the tax office is aware that, if an individual has prepared their tax return using the MyGov site for 2018, if they tried to claim a work-related deduction or some other form of deduction that was outside of what the ATO viewed as the benchmark parameters for somebody in that sort of role, they would have a little pop-up box that would appear to say, just letting you know that that's different to what others in your that do similar work to you have claimed. So is this correct? Essentially, making you second guess what you've put in your return. So those sorts of things will only increase, and also the sending of SMS messages to individuals, reminding them to make payments that might be due. So whether assessments are due or BAS payments are due, etc., the tax office is using the SMS facility to be able to remind people, and they're saying that they're getting an increased collection base because of that approach. So that will increase over time.
Because Kim, I think I'm right in saying that by stealth, if you like, the ATO seem to be really putting a lot of energy and effort into their electronic platforms and the way that they're dealing with individuals, both a tax agent or individual going to the tax office or then coming back, and the data they're collecting. There seems to be a lot more, I'll call it AI for lack of a better word, but
yeah, I think you're right. I think there's a lot of they're utilising AI a lot more, which makes it a little bit more impersonal than it has been in the past, which also has its dangers, but it enables them to, I guess, find the low-hanging fruit pretty easily and concentrate on some of the bigger picture issues that hopefully over time that they will get some more traction on.
Yeah, and we were talking before about the single touch payroll scenario that we're going to be having. I think that's going to be quite interesting where that leads to into the future.
Yes, exactly. Okay, so I'll hand over to super for a change. This year there hasn't been a lot of super, but I've still managed to find some things that Brett can talk about.
And can I just say I'm very grateful for that for this year. I'm still recovering from 2 years ago. So essentially, there is only minor tinkering around superannuation in this year's budget, most of which don't actually start until 1 July 2019, or aren't scheduled to start until 1 July 2019. But first and foremost, something that was actually announced a couple of weeks ago, increasing the membership entitlements for self-managed super funds. So currently, they can only be 4 members inside a self-managed fund. They're increasing that. Granted, it's still an arbitrary sort of fixed figure, but it's increasing to 6 from 4. Now, the way that our constitution essentially works is that superannuation, it's a trust, so it still has to be governed by trust law, which is state-based. Now, most state trust acts only allow you to have 4 trustees, or no more than 4 trustees of a trust. So either they're going to have to ask most states to change their trust act to accommodate more than 4, or if you want to have more than 4, you'll have to have a corporate trustee. The ATO has had a a push over the past number of years that they want more people to have corporate trustees. So I actually think that this is just part of the scenario, the evolution of that scenario. Now, one thing I suppose that this does play out is if you have more members inside the fund, typically it's more likely to be mum, dad, and the kids. So if you have the kids in there and say Labor do get into power in the next 12 months during the next next election, and then they introduce their franking credit, the elimination of the rebate of the franking credits or the refund of the franking credits. Having kids inside the self-managed super fund is a way to soak up the imputation credits that mum and dad are creating. So there's some potential strategies that may sort of come into that there. One thing that's sparked a lot of commentary in the last essentially 12 hours is I'll call it a thought bubble by the government of moving SMSF audits onto a 3-year cycle. So what they're proposing is from 1 July 2019, so presumably that's the 2020 financial year, that funds that have a good lodgement history and a good record keeping, good compliance, and good lodgement history will only need to undertake an audit every 3 years. Now, it talks about a consultation process going through with industry and stakeholders and the like. That'll be a really interesting piece because there is a lot of vested interest, if I can say that, but also a lot of integrity that sort of starts to come into the whole system that becomes questioned. So that'll be really interesting to see how that plays out. I think it's one of those things that's good in theory, but in practice it's going to be quite difficult. Preventing inverted concessional contribution breaches. So from 1 July 2019, individuals that have multiple employers and earning over $263,000 can actually nominate certain employers not to pay superannuation guarantee. So this is primarily targeted at locum doctors, that sort of thing, that might have more than one employer that actually earn more than $263,000. So in that instance, they could go to their employer and say, hey, don't pay me the SGC, but instead pay it to me cash in hand. Now, the way the system now works for excessive contributions is it's going to be the same tax result, except for there's an interest charge that the individual would otherwise have to pay. So they're getting rid of that additional cost when ultimately the taxpayer has no choice in it. So that's really a good thing. Personal concessional contribution deductibility integrity. Now, this actually is one of the few measures for super that kicks in earlier, so from 1 July this year. And that's basically they're looking to add a tick box to the individual tax return to confirm they've met the notice of intent requirements when they're making a personal superannuation contribution, a concessional contribution. So there's a little bit of a recap around all this. For the 2018 financial year, so right now, an individual can make a contribution to super and claim a tax deduction for it, so long as their employer contribution and their personal concessional contribution are under $25,000. It doesn't matter where the source of the money comes from. In prior years it did, from now on it doesn't. What the government has identified is that people will claim the tax deduction inside their personal tax return, but they won't actually tell the super fund that they're looking to claim that as a tax deduction. So thereby they're losing their 15% tax that the super fund would otherwise be withholding. Now, they've actually put a pretty big number on this over the forward 4-year estimates. So they're estimating that they will, this measure alone will give them about $430 million. Now, it's not just about a tick box, it's also about ATO receiving additional resources to police this measure, to put some consultative measures in place, education, that sort of thing. So they're looking to throw a little bit of money to try and make sure that people follow the right process. Because whenever you put money into superannuation and you want to claim a tax deduction, you have to provide that super fund with a notice of intent to claim that deduction, and then they have to acknowledge it. Only then can you actually claim the tax deduction inside your personal return. One thing that's a little bit of an interesting measure, it's quite specific, and I mean, they've tried to bring it in as part of an aged care type arrangement, is that from 1 July 2019, if you're between the age of 65 and 74 and retire, you would normally need to meet a work test, or you normally need to meet a work test to put money into super when you're between age 65 and 74. What they're actually saying that is if you have a balance below 300,000, so that's a total superannuation balance below 300,000, in the first year after you retire, you can put contributions into super, be that concessional or non-concessional. So currently 25,000 concessional or 100,000 non-concessional. So they're really trying to target, I suppose, older Australians that don't really have a lot of money in super, allowing them an extra year of grace to get money into super. So I don't think that's something that'll be used heavily. However, I think it's not a bad encouragement for those that have retired, that if they perhaps sell an asset, looking to divest themselves and put more money into super, that's a way that they can do it. And a couple of other changes that really are fleeting around the edges. From last time I sort of checked, there's about I think 13 million taxpayers in Australia, and we've got about 25 million superannuation accounts. So on average, everyone has more than 2 super accounts. So what they're trying to do is that if you meet a certain criteria, so below 3%, if you have below $6,000 inside your super fund, then your annual fees are capped at 3%. You can't be charged more than that. Also, they're getting rid of exit fees from super funds. So some funds have charged $50 or $100 or more to leave, particularly the older super policies. There may have been substantial exit fees with those. The government is basically banning that. And also, from 1 July 2019, insurance that is normally a default option will become an opt-in in certain criteria. So you've got to be under 25, have a small super balance, things like that. So it's very specific, but they're trying to, I suppose, help those that have low superannuation balances. I think it's back to you now, Kim.
Excellent. Okay, so in relation to the business side of things, like we said, the concentration was mainly on the personal tax cuts, and because we've got an election coming up. But from the business perspective, a couple of changes were announced, some not unexpected, I would have to say. The $20,000 immediate asset write-off has been extended for another 12 months. So so where there's assets, including grouped assets that are purchased as a set, costing more than $20,000 and installed ready for use prior to the 30th of June 2019, they'll still need to be pooled. But if you're a small business entity, then you'll get an immediate tax deduction for assets that cost less than $20,000, provided that they're installed and ready for use prior to the 30th of June 2019. So like I said, just really an extension of that that deduction that's been around for a couple of years now. Now, I guess it's important to remember in the context of this immediate write-off that this applies to businesses that have got an aggregate turnover of less than $10 million. There are a lot of entity threshold tests around at the moment where you're determining what the aggregate turnover might be. Remembering aggregate turnover does link back to the provisions that relate initially to the small business CGT concessions, where you need to look not only at the taxpayer but also entities that might be connected with or affiliated with the taxpayer. So you can't just look at a company on its own or a trust on its own and say, yes, it doesn't have a turnover of more than 10 million, so it's okay. You need to look at all of the other entities in that group to see whether the turnover threshold might be breached. The other not unexpected announcement last night was that the Division 7A reform that has been on the table for a number of years now, that major reform has now been delayed again for another 12 months, so till the 1st of July 2019. And I wouldn't be surprised to be sitting here in 12 months' time and saying it's been delayed again, because it is quite a complex issue to get around. So that major reform is delayed again, and so we continue on dealing with the Division 7A rules as they currently stand, with one possible exception, and that relates to unpaid present entitlements. Now, the Division 7A legislation is going to be amended to clarify the circumstances which apply to UPEs, these unpaid present entitlements. And the measure is essentially going to ensure that the UPE is either required to be repaid to the private company over time as a complying loan, or it will be subject to tax as a dividend. Now, there's not a lot of detail around in relation to that at the moment, given that we're just the day after the budget, but I'm sure there'll be a lot of interest around what those changes are actually going to be. I always get nervous when they say they're going to clarify the circumstances where something's going to apply. It usually means it's going to be more complicated than what it was to start with. So the start date for these targeted amendments, like I said, is deferred for the major amendments to the 1st of July 2019. Now, some other tax-related or business-related items that were announced last night related specifically to, or one example was the tightening of the thin capitalisation rules. This is something that impacts mainly on businesses that undertake international dealings with related parties, and it's something that is, well, more and more we come across in the SME sector, because more and more businesses are doing business around the world. So it is something that needs to be considered. It's not just a big business issue like it was when it was initially introduced. So from the 1st of July 2019, there's going to be a need to align the asset values for thin capitalisation purposes to the value that's reflected in the financial statements. It's really just an integrity measure to ensure that when the thin cap rules are applied, that we're comparing apples with apples rather than trying to apply the value of assets in the financials for one purpose, but a different value for thin capitalisation purposes. The other item announced last night related to managed investment trusts and attribution managed investment trusts. There were some changes announced a few years ago that have provided MITs with a perceived benefit that the government wanted to stamp out, I guess. So these changes are going to prevent MITs and AMITs from applying the 50% CGT discount at the trust level. So that doesn't mean that the discount can't be applied at the beneficiary level, but it's really just ensuring that the MITs and the AMITs will operate as genuine flow-through vehicles, flow-through tax vehicles, so that the income is actually taxed in the hands of the investors as if they'd received invested directly. MITs and AMITs that derive capital gains are still going to be able to distribute the income as a capital gain, and it can be discounted in the hands of the beneficiary, where the beneficiary is entitled to the discount. Now, Brett mentioned initially about landholders and deductions for individuals holding, or sorry, for taxpayers holding land. So from the 1st of July 2019, the government's announced that tax deductions won't be allowed for expenses that are associated with holding vacant land. So this integrity measure is being introduced to address some concerns that are around that deductions are being claimed for expenses, for example, interest costs, that relate to holding vacant land, but the land's not actually genuinely held for the purpose of earning assessable income. It's also going to reduce the tax incentives around in relation to land banking. So the measure's supposed to only apply to land held for residential or commercial purposes. However, there will be a carrying on a business test that will generally exclude land that's held for commercial development. Now, deductions that are denied under these new measures won't be able to be carried forward to be used in later years. But where expenses that relate to those denied deductions would have been part of the cost base of the asset, an example is borrowing costs or maybe some rates, then they could be included in the cost base of the asset for CGT purposes when it's sold. So just something to keep an eye out for if you're involved in the property development sector on a small scale or a larger scale, because this may have an impact on any feasibilities that you're doing. Another integrity measure relates to the use of the small business CGT concessions in relation to the assignment of partnership rights. Now, those concessions are no longer going to be available for partners that try to alienate their income by creating or dealing in rights to future income in respect of a partnership. And this measure, importantly, applies from 7:30 last night. So the tax office had expressed some concern, or a few years ago, the tax office issued some guidelines on how income from partnerships should be distributed to partners, particularly professional partnerships. And then last year, they quickly withdrew essentially without notice, withdrew those guidelines. So we've been in a bit of limbo as to what was going to come of that. It seems that the major concern was particular individuals exploiting what the government originally intended as to how these rules would work, and how Everett assignments, so the assigning and dealing with the rights to the future income from the partnerships were dealt with. Last week, the tax office announced that they were going to be making further comment in the not too distant future. And surprise, surprise, the budget last night said that, well, this is one aspect that they're going to be dealing with. So it's something to keep in mind if you're dealing with the assignment of partnership interests in whatever form, and that might be creating them or assigning them or dealing with them in some other way. Making sure that it's not just for the purpose of the small business concessions that the benefit you think you're going to get from that. Other than that, the small business concessions, CGT concessions, are not being amended. So the concessions are going to continue to be available for eligible small businesses where they have an aggregated turnover of less than $2 million or net assets of less than $6 million. Now, this is, again, another one of those areas where aggregated turnover is important. For this particular test, it's these concessions, the turnover is $2 million rather than the $10 million that's used in other areas. Two other quick items to mention is that the Treasurer announced that there is an issue in relation to taxing of digital businesses. It's the great headache of revenue authorities around the world at the moment as to how they deal with taxing digital business that's occurring increasingly. There will be a discussion paper released shortly, so I'm sure we'll there'll be some interesting reading in that. On the GST front, though, there weren't really any major GST measures announced, so that was interesting and I guess good in some respects. Okay, Brett's going to have a little bit of a chat about how our infrastructure is going to improve over the next little while.
And essentially that's just because it's not fair for Kim to keep on talking. So look, essentially the ongoing substantial infrastructure investment that this government's making, it sort of makes political and economic sense. So politically, because a lot of the proposal or projects that they're looking to run just so happen to be through marginal seats, and economically it creates jobs. So yes, they're buying jobs, but that still helps stimulate the economy. So there's $24.5 billion of new money that was announced in the budget. As you can see from the little infographic we've got up on the screen there, most of that is actually going to be spent in both Victoria and here in Queensland. So Victoria is about putting a train between the city and their airport, and up here in Queensland, it's really about the Bruce Highway. So spending some money on that, as well as obviously the M1. Apart from that, most of the remaining items, they're more, I suppose, minor, if I can put it that way, as far as upgrading to certain rail and road infrastructures. Probably the only other thing worth of noting, which you may have already heard, is the metro line, or the metro project here in Brisbane. The government's fully funding $300 million for that. So really there's a fair bit being spent on infrastructure, and this is all part of a rolling $75 billion commitment that this government made 1 or 2 years ago now. So about every budget they throw another 20 billion or thereabouts at it as those previous projects come off. Now obviously that's over a long time period too. Some of these projects will take 10 years to get up and running or for completion. So it's a cycle of infrastructure spending that they're going through.
Okay, I'm back again. There were some changes mooted last week and the week before in relation to R&D, and there's a perception out there that the number of applications for research and development may not strictly line up with the amount of R&D that is really happening and providing the policy benefit that's supposed to be around in relation to providing these incentives. So R&D was always going to figure in last night's budget. However, the extent of the changes that were announced wasn't quite as significant as some of us might have been thinking were going to happen.
That seems to be a bit of a common theme throughout this whole budget, though, Kim.
Yeah, I think so. Well, businesses don't get to vote; it's individuals do. So the things that we thought should have been done or could have been done to improve integrity or whatever you might want to call it have tended to take a bit of a backseat. Mm. Yeah. Let's get another term of government first before we do anything, all the bad stuff. So in relation to R&D, the changes that are supposed to take effect from the 1st of July 2018. And there is a difference in how these changes will apply depending on whether the entity itself has a turnover of less than 20 mil or more than 20 mil. So for entities that have a turnover of under $20 million, there's going to be a cap of $4 million cash refundable tax offset. It will exclude some clinical trials. What happens if you're over the $4 million cap, though, is that the amount over the cap becomes a non-refundable offset, and anything that's not used can then be carried forward. Now, the amount of the offset itself has changed a little, and I think it's really tinkering around the edges, but So it's now linked to the claimant's tax rate plus 13.5%. So for an entity that's, which will be a company, because companies undertake the R&D, for a company that is subject to tax at 30%, then it'll be a 43.5% offset. But if the entity itself is a small business entity, then the lower corporate tax rate applies at 27.5% at the moment, then the maximum refundable offset will be 41%. So again, it becomes important. This is another area where it's important to look at what the turnover of the entity is as to whether the entity is going to be subject to the higher refundable offset or the lower. Now, the announcement last night did talk about base rate entities, and that's essentially the new term for small business entities, provided that the government can get these company tax changes through. So just when you're seeing comments around about small business entities versus base rate entities, in the context of tax, they're a little interchangeable, but you should consider what both of them mean, because they might have a significant impact on what you can and can't do. Where the entity has a turnover of more than $20 million, then it's a non-refundable tax offset that's going to be linked to the R&D spend intensity. So essentially, it's going to work in a similar way to marginal tax rates. So for the non-refundable offset for the first 0 to 2% of spend compared to total expenditure, there'll be a 4% offset. But for the next 2 to 5%, it'll be 6.5% of that spend, and increasing up to, if you're spending 10% or more, then it'll be a 12.5% of that 10% spend. And the spending cap is going to be increased from 100 mil to 150 mil. And of course, with these things, there are always integrity changes. So from an integrity perspective, there'll be additional resourcing so that the government can ensure that ineligible R&D claims are denied. There'll be more transparency for the public, so they'll be publishing the company names that claim the R&D and the amounts of the R&D expenditure that they're incurring. There'll also be the ability for Innovation and Science Australia to produce binding guidance on what is eligible R&D. So at the moment, because of the nature of research and development activities, there are a lot of items out there and issues that are being dealt with. Sometimes people aren't sure, taxpayers aren't sure as to exactly whether it is R&D, whether they've met all the criteria from their investigations they have, but there may be some other things they're not aware of. Then getting this guidance from Innovation and Science Australia may be somewhat helpful in that regard. And then from an administration perspective, there'll be a 3-month limit on extensions of time available when there are applications, registrations and reviews are due. So in relation to business again, there's been a lot of talk over the last few years now in relation to illegal Phoenix activity. And so that there's a further, I guess, work being done to reform the corporations law and tax law to provide resources to essentially introduce new offences, prevent backdating of director resignations in order to avoid, so that they can avoid liability or potentially leave the company with no directors, and also to extend the director penalty regime so it will include things like GST, luxury car tax and wine equalisation tax. So essentially all debts that may be owing to the tax office, the director will be personally or may be personally liable for. The other interesting point from last night was that there will be a a cash receipt limit introduced for businesses. So from the 1st of July 2019, there'll be a limit on cash receipts for a business to $10,000. So you can't pay cash to buy your car from the dealer. Consumer-to-consumer transactions are excluded, and also bank transactions are unaffected. You know, there are other pieces of legislation, AUSTRAC, etc., that trace the funds moving through banks. But yeah, so it's really just trying to provide a hit to the black economy, and it'll be interesting to see how that is actually monitored and regulated.
Well, we know Commonwealth Bank did really well with that, didn't we?
No comment. Other integrity measures as far as businesses are concerned is that there'll be no deduction for payments to employees where the PAYG obligations haven't been met by the employer. So the single touch payroll that's being introduced this year will be helpful, I guess, from the tax office perspective in monitoring this, to make sure that they can police it. But if your PAYG obligations aren't up to date, then you don't get a deduction for the payments that are being made to employees.
And Kim, am I right in saying that tax agents are going to have a greater responsibility in how this works now too, it seems?
Well, there is increased funding, which we'll see shortly, in relation to the Tax Practitioners Board, to make sure that tax agents are doing what they should be doing as well. So I think that there will be an increased focus on it from a tax agent perspective. And my comment earlier about looking at individuals' returns, the data matching that the ATO can do make it pretty easy for them to see whether the PAYG has been paid. Yeah, so now this just gives them another avenue. And then increased e-audit activity, the increased use of cloud software to do the accounting, etc. There's ample opportunity for them to be able to see that information sooner rather than later. Yeah. Tied in with that, there'll also be no deduction for payments that are made to contractors where ABN withholding obligations haven't been met. Now, this is an area that ever since the ABN withholding legislation was introduced back in the day, it hasn't really been strictly monitored, I guess. There hasn't been any real activity to try and stamp it out. But we're essentially going back to the days where we diligently need to check that the ABN withholding obligations are satisfied, and that the contractors provided us with an active eligible ABN, and if they don't, then we withhold, and at the top marginal tax rate. And if we don't withhold, then that's fine, but we don't get a deduction for that payment made to the contractor. I think some of that's probably stemmed from, there was talk over the last couple of years of some contractors using Bunnings ABN on all of their invoices, which was probably not the smartest thing to do. There'll be a general targeting of non-payment of tax and superannuation debts, again, making sure that employers are doing the right thing by their employees. The tax payments reporting system is going to be expanded. This originally started with the construction industry and is now going to be expanded further to include security providers and investigation services, road freight transport services, and computer system design and related services. Related services always makes me nervous. The last point there relates to circular trust distributions. There's some anti-avoidance rules around in relation to making these circular distributions. And essentially what this is going to do is include family trusts in that anti-avoidance net. So where family trusts act as beneficiaries of each other, then in a round-robin sort of arrangement, a distribution can move from one trust to another trust and then back again in a way that avoids any tax being paid on that amount. So this integrity measure is really there to enable the tax office to pursue family trusts that engage in that those sorts of arrangements. and will impose tax on the distributions at a rate equal to the top marginal tax rate plus Medicare. So something to keep in mind when dealing with trust distributions, because that time's coming up as well.
Just quickly looking at some aged care initial announcements that were made in the budget, albeit there wasn't as much as what many were hoping. The pension loan scheme, that's where an eligible retiree can borrow a maximum of 150% of their age pension that they're receiving. So basically that's paid fortnightly with interest compounded at 5.25%. And essentially it's underpinned by the equity within inside the home. And it's limited to 50% of the age pension that the individual or the couple receive each year. So worst case or best case, if you like, you can only receive it for 3 years, but you may be able to if you extend that out if you don't take the maximum each year. Home care packages, they've allocated an additional money for 14,000 high-level care packages by 21-22. Once again, Kim and I were talking earlier, and she mentioned apparently there's about 100,000 people looking for those sort of spaces. So this is but a mere drop in the ocean for what's really needed. 82.5 million for mental health services, those that are in aged care facilities, and 20 million to help older Australians remain connected to the community. That's a pilot program that they're running. And $23 million to boost physical activity for older Australians. They're also looking to spend almost $62 million on improving a website for my aged care, which seems horrendous to me, and $14.8 million to streamline assessment processes for aged care services.
Some of the other measures that were announced last night, as I mentioned briefly before, tax practitioner fees, the fees we pay to the Tax Practitioners Board will increase to fund the increasing responsibilities and ensure that we all maintain our professional and ethical standards. Combating illicit tobacco from the 1st of July 19, there'll be a collection of duties and excise at the border on import of tobacco rather than when they try to sell it. So that they're hoping should collect more revenue. Whether it stamps out the illicit tobacco or not remains to be seen. There'll be excise changes for craft brewers from the 1st of July 19, an increase in the alcohol excise refund scheme cap, and also the excise rates are going to be increased. I mentioned before about single touch payroll. I don't think that issue is getting as much traction in the market as in small businesses as what in business generally as it needs to. So there's an additional $15 million to support modernisation of payroll and superannuation reporting. That money is being given to the tax office. So that'll probably be more in line with them being able to keep an eye on what it is that we're paying people over and making sure that we're maintaining their superannuation contributions, etc. The Banking Royal Commission, as I'm sure you're not surprised, there was going to be additional funding for ASIC and APRA to assist with their involvement in the Royal Commission. And the last point there is just in relation to, there is a legislative backlog. I was looking this morning at the list of legislation, tax-related legislation that's currently sitting in Parliament, and also draft legislation waiting to be introduced. It's quite significant. So, so there's a lot of work to be done, either by this government or the next.
Some more measures that were announced. The Pharmaceutical Benefits Scheme, a new and amended listing on the PBS would expect to increase payments by $172 million. $1.3 billion on a national health and medical industry growth plan, which is designed to help generate the economy in relation to medical technologies and the like. Increase in health funding by about $7 billion Now that's out to 2022, bearing in mind. There's also, you might have heard, $500 million for the Great Barrier Reef to help for things like the crown of thorns starfish and the like. $1.9 billion over 12 years for a national research infrastructure body to help Australians deliver new technologies, if you like, to help the economy. That can be over a number of different areas. And finally, we're looking at $225 million to help our GPS facilities, and $41 million to establish a national space agency, which ironically is that's less than what they're spending on the Captain Cook Memorial in Sydney.
So the last thing, just before we finish off, there wasn't really any talk last night about the corporate tax rate changes, and that's more than likely because the Senate has dug their heels in and won't pass the current legislation that the government's introduced. So this here is really just a reminder of where things sit. Could change tomorrow, I don't know. So just, I guess, keep in mind that even though with the budget and the personal tax changes, there are still some corporate tax changes that are in the wind and will have an impact on how we look at doing things in the future, structuring wise, but also just working out what amount of tax and how dividends can be franked going forward for companies.
Well, you might find, Kim, that the government might wait for the new Senate to form, because we've just received news that there's been some more movements over the whole dual citizenship arrangement. So,
so I think we've got 5 by-elections coming up. So there's there'll be a little bit going on. Politics, it's always interesting. So just before we sign off, for those of you that haven't received our budget report that was emailed around last night, you can get a copy from our website, and the link is here on the slide. But it's if you click on our website, it's one of the banners that shoots across the front of the page at the moment. So if you've got an interest in having a read of it, please feel free to download it.
And with that, thank you for joining us this afternoon. This budget was essentially a lot about nothing, but apart from some future income tax measures that hopefully we will see in the not too distant future.
But if you've got any questions about the budget items or anything else, please feel free to give us a call or shoot us an email.
All right, and thank you for listening.
Thanks. Bye.